case studies. All of the 4 we are covering. So today we will be covering the liquidity risk. Here, objective questions on liquidity risk in treasury. Important part, this module C, BFM. Okay, today we'll be covering that. So let's start here. One thing I'll tell you, follow the series completely because various questions are covered over here. If you follow it part by part, so today you follow it, tomorrow you don't follow it, then you will miss out on the important lectures. Okay, so let's move on. Today we'll be doing the objective questions. I'll be asking you the questions and explaining you as well. Not only I'll just ask you or give you the answers here. Answers are not that important. Explanation is important. Answers you can definitely get it in the books also, right? Which of the following foreign exchange operations have been useful in treasury management operations? Which of the following foreign exchange operations? So which of them foreign exchange operations have been useful in treasury management? Arbitrage, swaps, A and B both, and none of these. Now I'll tell you one thing. Firstly, give me the answer. Then I'll give you where are the loopholes. Type the answer. Is it capital A? Let's mark only this. A, B, C or D. What is the answer? Many of you have answered this C correctly. C is the answer. Right? But before going ahead to the next question, C is the answer, agreed. Have you understood what is arbitrage? Have you understood what is swaps? If you have not understood it and you are just typing, you have heard some word about arbitrage, you have heard some word about swaps, and you are saying, yeah, in treasury they are used. So I'll take both A and B. No. Don't do that. In BFM, you need to understand the things. That's important. Okay. What is arbitrage? Arbitrage means buying from one market and selling it to another immediately. For example, I'll give you a simple example. We see that sabji wala, vegetable vendor, vegetables. The one who comes on the road near our house. Sabji le lo, bhaji le lo, right? That Nana Patekar, you remember in that movie, No Entry? Aloo le lo, what gobi le lo, that sabji wala. What does that guy do? That guy does this arbitrage. What does he do? He buys it from the dealer. Dealer means distributor, dealer, and immediately same day sells it to the retailer, means retail customers, to us. Let's call us only customers. Okay. So what does this distributor do? He buys it from this dealer and sells it to the customer on the same day. Okay. So today, if we today morning, generally this vegetable market is in the morning between 4 to 7 a.m. in the morning. Okay. There the whole wholesale market works. And after 7 a.m. this retail market works. So this guy buys it over here from the market on the same day, day 1. Let's say D1 only, day 1. And this guy sells it to the customers on the day 1 only. See here, vegetables can't remain for the next day. These are perishable items. Tomorrow if somebody comes to sell you today's vegetables, immediately one can recognize that these are old or stale vegetables. So that's why this guy has to purchase only that amount which he can sell today. So that is arbitrage. Buying in one market and selling it into the other end, earning the commission on this. Similarly in BSE and NSE also. Suppose if there is a Reliance share. Okay. I buy it on NSE at let's say 2500. And immediately I sell it on BSE. Suppose there is a gap, price gap between these two exchanges for let's say this happens hardly for 4 seconds. So there is a gap of 2500 over here and it is 2503. 3 rupees gap is there. So what will I do? I'll buy 1 lakh shares over here and sell 1 lakh shares over here. So what have I done? I want 3 lakh. 1 lakh into 3 lakh. In how many seconds? 4 seconds. That is arbitrage. Safest. Okay. Swap means what? Swap is different. In swap, always remember, I'll just give you one basic over here for swap now. In swap, always there is one leg which is fixed. One leg that is fixed and other leg that is floating. Okay, floating. One leg is fixed, other leg is floating. For example, if I take 1 lakh rupees from you, 1 lakh, okay, and I guarantee you 7% rate of interest. So this is what fixed. I am guaranteeing you 7%. Okay, so this is going out. This is minus, right? For me, it is out. So I'm guaranteeing you 7% rate of interest. So this is fixed. And what do I do with this 1 lakh rupees? I invested it, let's say, in the stock market. Stocks. Now these stocks can give me, either they can give me 50% returns also, right? Or they can give me 0% returns also, or minus also, minus 50% also. Anything can happen. So this is floating. So in swaps, always remember one leg is fixed and other leg is floating. Okay. So that's why the answer is both A and B, and these both the operations are used in forex as well as in the treasury bonds also. Risk in trading securities may arise from the following. So trading in securities may arise from what? Now this is a very simple answer. Trading in securities may arise due to what? Number one, foreign exchange transactions. Second, equity holding. Third, lending and repos, and all of these. So trading securities may arise because of what? This forex. Definitely, if the rate of the dollar goes up or down, definitely that will affect it. Equity holding. How much equity I am holding? Equity holding means what? Suppose if I am holding the shares of, let's say, Infosys, Reliance, TCS, all these companies. So that is my equity holding. So if it goes up, share market goes up, stock market goes up, I'm benefiting. If down, I'm losing. Lending and repos. This is basically related to bonds. Remember, lending and repos mean, repos are the, what do you mean by repo? Everyone. What is the repo? Repo is the rate at which RBI lends to the banks, right? RBI gives money to the banks at repo. Remember, this repo is traded in the market. Traded. You'll say, how can it be traded in the markets here? Repo is what? RBI has given you money at this rate. Okay. So if tomorrow after 6 months, or let's say after 3 months, the repo rate decreases, then it will be this, the rate at which it was given earlier is at higher rate. Let's say it is, let's say 5%, example I'm giving you. After 3 months, it becomes, let's say 4%. So the one who is holding the 5% repo will be at an advantage. So that's why it is traded. So here, trading is done wherever there is a gap in the interest rates. Trading is done everywhere. So the answer is all of these over here. Okay. Which of the following is not an agency service of the bank? Agency service. Agency means what? Here the bank is acting as an agent. Agent. Agent means what? LIC agent. Remember this? LIC agent. Insurance. Or any other agent also. Means mutual fund agent. What does the agent get? Agent gets only commission. Same thing, bank also gets only commission in agency services. So which of them is not the agency services? Extending credit, escrow, merchant banking services, and insurance selling. So which of them is not the agency? Not. They are not acting as the agents. Now very easy one but tricky one. You can immediately see the answer. Let me see how many of you can answer over here. Correct. Extending credit. It is not an agency commission over here. It is the core business of the bank. What is the business of the bank? Basic business of the bank, right? Deposits and loans. So extending credit is a basic business. Escrow, merchant banking services, insurance, and these are all the agency services. Okay. Escrow will take a lot of time. Otherwise, I would have explained you. Escrow is actually, I'll just give you one liner. Escrow is a temporary account. When two parties don't trust each other and they have some funds in common or something in common. This is generally done in road contracts by large companies, or even two buyers and sellers in different countries. If they don't want LCs, okay, they don't want the cost of LCs, so they use this escrow account. Temporary accounts, yeah, the funds are kept in the bank account, right? And it can be taken by, means it can be withdrawn by the sign of both. Okay. It's like a joint account. Okay. So escrow account is that. Merchant banking services, again, one liner only. Merchant banking means basically whenever you have that IPO, right? Reliance IPO, TCS IPO, all these IPOs. There the services are given by the bank as merchant banker. And insurance selling, you know. Everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests, whatever we require, you get it over here. So that's why download it right now. Okay. And don't just download it. Start studying also. Otherwise, how many apps do you have in your mobile? How many apps do you have in your mobile? Can you even tell me the number of apps? Not possible. My second question, how many apps have you actually used in last 1 week? How many apps have you actually used in last 1 week? I'll tell you. WhatsApp, right? WhatsApp is the app you have used. Some banking app you might be dealing with, any bank, right? If you're dealing in shares, then this app of this DP, right? Then what? Nothing else. That's it. And some YouTube and all these things. So that's okay. So we don't use the apps that much. We just download them and keep it for some time, and that sometime never comes. Same thing should not happen with this app. Download it and start using it on a daily basis. Okay. What is off balance sheet risk? Off balance sheet, which is outside the balance sheet. Off balance sheet. Okay, it is contingent in nature. Contingent means what? It is not for present, but it may come in future. It can occur on account of issue of guarantees. So guarantees is what? Again contingent, come in future. Right? Bank's commitment may happen on account of failure to meet the payment obligation. That can also be possible. Means when I issue the guarantee, what does it mean? I'm telling somebody, if this guy doesn't work, I will pay you, whatever your losses are. So actually, if this guy doesn't work, then what? I'll have to pay it. So that's why it may get converted into cash, and this is known as crystallization. Crystallization means crystallization means converting the contingent liability into real liability, means cash flow liability. So the answer is this. Oh, let me get it from you. So what is the answer? Contingent, guarantees, crystallization. What is the answer? Off balance sheet. It is D. All of the above, correct? All of them are the off balance sheet items. None of them is of the on balance sheet items. What is the off balance sheet item? Off balance sheet item means here I don't pay cash right now. Right now I don't pay cash. That is off balance sheet. Balance sheet item means what? There I pay the cash. CC, term loan, I'm paying the cash. Guarantees, I'm not paying the cash. Okay. Which of the following statements is correct? Now I want the correct one. Okay, correct. You should always mark what is required in the exam. Correct or non-correct. True or false, whatever. Okay. The funding risk may arise from the need to replace the net outflows due to unanticipated withdrawals of the deposits. So, net outflows, whatever outflows are there due to unanticipated withdrawals, everyone is coming for withdrawal. So, you'll definitely face the funding risk. There won't be any money, right? If everyone comes for withdrawal. So, is this correct? Yes, A is correct. What about B? Now, I want to answer from your side now. Time risk arises when the performing assets turns into NPA. Is this true? Time risk, what is time risk? Let me explain you, but I won't be answering this now, whether B is correct or not. That is what you should answer. Time risk means what? It's a part of liquidity risk. Here in liquidity risk, I don't get money on time to pay for my liabilities. That is time risk. Now tell me whether this B is right or not. When asset turns into NPA, means my performing asset becomes NPA, then I won't be getting the interest, whatever that asset was going to give me, loan was going to give me. So that's why it is again 2. So if 2 are correct, obviously this answer will be D. Let's see the third one also. Call risk arises due to crystallization of contingent liability. Just now we saw. Crystallization of contingent means what? If I give the guarantee on behalf of somebody and that person does not perform. So in that case, what happens? If that person does not perform, then I'll have to pay for the losses of that third party. Isn't it? So when I have to pay for this, this is called as crystallization, and this is known as call risk. Okay. So third is also true. Okay. This is also true. So the answer is all of these. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you'll be getting number one, free YT series on all the subjects, and number two, latest updates from IIBF regarding the exams. They give various notifications. This timing change, that timing change, this portion added, that portion added, something, everything. Okay. The features of interest rate risk are interest rate risk. What is interest rate risk? Interest rate risk means the interest rates may go up or down depending on what the RBI is doing or whatever this foreign situations are, means world situations are. So that is interest rate risk. It is an exposure of banks' financial condition to adverse movements in the interest rates. Financial condition to adverse movements. Here, adverse movement means against your will, means against your wish, you can call it. Okay. So is it that? Yes, it is that. What about the other one? Second one you give me. It has no effect on net interest margin. It has no effect on NIM, net interest margin. I know many of you have typed this answer D now. D. I am seeing D answer. All of these. But remember, all of these, D is, we generally have the tendency of marking all of these, none of these, either A or B. We have the tendency of marking them as an answer, but it's not always correct. Okay. So here B, it has no effect, that is wrong. It has an effect. Interest rate risk will definitely affect my NIM. It may not affect the market value of the equity. That is also wrong. Market value of the equity means whatever is my stock price. If I am facing an interest rate risk, immediately the stock market grasps it and knows it that yes, I am facing the problem. Immediately my stock price is affected. So answer is only A over here. Okay, only A. Which of the following is not a mismatch risk? Mismatch. What is the mismatch? Mismatch means assets and liabilities mismatch. Okay, not. We want not, but not a mismatch. Always focus on what is required in the exam. Okay, holding assets and liabilities with different maturities and amount. Is it not a mismatch risk? Liabilities I am having for 3 years, assets I am having for 1 year. Is it not a mismatch? Yes, it is a mismatch. So I want not a mismatch. This answer is true. I want a false answer. This is. What is my requirement? F. This is my true. T. Adverse movement in the interest rates. So is it not a mismatch? Adverse movement. Yeah. See this. Let me see the answer from your side. What is C? When the liability is repriced on maturity date and this causes variation in the interest rate. So what is this? Firstly, tell me about B. Adverse movement in the interest rate risk. Is it not a mismatch or is it a mismatch? It is a mismatch. Why? Because adverse movement in the interest rate risk will definitely affect me. For let's say same case, asset for 1 year, liabilities for 3 years. If the interest rate moves in adverse directions, it will definitely affect my asset and liability positions or my net profit over here. What about the C? When liability is repriced on the maturity date, this causes variation in the interest rates. So, when liability is repriced, see, this is known as repricing, reinvestment risk, repricing risk. So, this is not a part of mismatch. This is false. This is a reinvestment risk. Okay. How to join the Officers Adda 24/7 YouTube channel? Either YouTube or you can join the LinkedIn using this blue. Scan this QR code right now. Scan this black QR code right now for YouTube. This blue one for LinkedIn. This third one for this Instagram. Join immediately. We are giving various free YouTube series, various questions, various tests freely on that. What is the yield curve risk? Yield curve. Yield curve means it is yield. What is the yield? Yield means basically what are the returns I am getting from the bond. Formula is very simple. Coupon upon price, right? Into 100. Of course, everything is into 100 only. So this is yield. What is the yield curve risk? When I plot this yield for various maturities, here this is time, okay? Various maturities I plotted. So if I plot it for various maturities, okay, then the curve which I get is known as the yield curve. So when two different instruments maturing at different time horizons for price, assets and liabilities, so that is basically yield curve risk. So A is right. There may not be parallel movement in the interest rates of both the instruments. Means let's say this is 3 months bond and this is 10 years bond. So both of them will move differently. So that is also true. So once you get A and B as true, the answer will be all of these. Okay. So look at the third one also. Non-parallel movement in the yield curve may affect the net interest income, obviously. And net interest income will be affected if 3 months moves faster and 10 years move slower. So it will be definitely affected, isn't it? So that is again a yield curve risk. Got it, everyone? So what is the yield curve risk? Everyone has got this? Okay. Now take one for the homework. Which of the following statements is correct regarding the yield curve risk? Now I won't be answering this. You get it from your side. Tomorrow we'll see it. A bank needs to evaluate the movement in the yield curves and the impact on the curve on the portfolio value and the income. In the paid class we'll say this. Okay. I'll give the answer in the paid class over here. If the liability is raised for 364 days T-bills and is used to fund on the asset for 91 days, it would yield to the yield curve risk. And both end. Check this answer, okay? I'll be back tomorrow with another series. But before going, everyone join the Sankalpa batch for the CAIIB. All the 4 subjects are covered: numericals, objective questions, case studies covered. See this Mahapack. Mahapack will give you, there are 2 advantages now. Firstly, you are getting the discount also, 77%, and you are getting double validity also. So that's why join this Mahapack right now. You're getting multiple batches over here. How to join this? Let me show you. So see how to join the Mahapack as well as the batches. Okay, let's see. See this on Adda 24/7. I would always suggest you to go through the app, because in the app you're getting the coin systems. Okay. So in coin systems, as you go on collecting the coins, you get better discounts, almost up to 1%. So go to JIB and CIB. Click on CIB November 23. You'll see this Sankalpa batch. Okay. Click on this Sankalpa batch. Sankalpa. Join this Sankalpa batch. Okay. See here. Test series, ebooks, online live classes. Look at the numbers: 81 test series, 87 ebooks. Click on these ebooks, and importantly, look at this: recorded videos, interactive classes, expert faculties. Click on these ebooks. Look at this subject-wise ebooks you are having. Each subject. Look at this. Each subject. Okay. Click on this subject. Now we are having chapter-wise ebooks. In such details you are having. Plus, let's see the test series. Test series. Subject-wise test series. Look at this. BFM. Then ABFM. Click on any of these subjects. You'll see this further details: mock 1, mock 2, mock 3, difficulty level, easy level, all these things. Okay. So that's why join this Sankalpa batch immediately. You can join the Mahapack as well. In right now, see, 80% off is going on for the fees. Okay. 4799, such a huge discount. Now let me show you the Mahapack. In Mahapack, what are you getting? You are getting double benefit. See, double validity plus 80%, both the things. 80% off is going on over here, plus you are getting double validity also. Double validity means you buy it for 6 months, you get it for 12 months. You buy it for 12 months, you get it for 24 months. Okay, so that's why I would always suggest you to join this Mahapack as well. And in Mahapack, what do you get? You get multiple batches, you get ebooks, you get tests, marathons, mini Maha marathons. Okay, electives also you get it in Mahapack. So that's why how to join this? Click on buy now. Fill in the details. See, continue. Code is already applied. 80% off is already applied. Click on continue. Fill in your details, and that's it. Make the payment. That's it. Okay. So I would suggest you to join this Mahapack or the Sankalpa batch immediately. I'll be back tomorrow with another series, and remember, any query you can call on the number which is highlighting over here. Okay. Call on this number. and join the batches. Bye.